the current market condition, with the coronavirus outbreak and the economy faltering, all may seem doom and gloom with our country. Yet, there will always be opportunity for investment. Good morning, everyone. We are Team A, and we are recommending a buy on WHA. Despite the market risks, we believe that with its strong fundamentals, future growth potential, and attractive valuation, we can reaffirm our buy recommendation at a target price of 4.3 baht, with a 25% upside based on yesterday's price. Let's first look at the fundamentals. WHA is a leader in industrial service, providing a range of services from warehouses to water and power. With its fully integrated business model, WHA possesses a diversified portfolio that is able to serve every customer need. WHA is a market leader with 38% market share based on land sales in the last 10 years. It has the most number of estates out of all of its competitors, providing it great flexibility and clustering advantages. And on a more recent note, last year, WHA sold about 1,000 right of land, which is much higher than its two closest competitors, Hamata and Rojana. This highlights the company's continued strength in acquiring new customers. The company serves customers from a variety of sectors, from consumer goods to its key customer segment in automotives, with partners such as Nissan and SAIC. This not only allows the company to diversify away sectoral risk, but also supports its long-term plan to shift to newer target S-curve industries. And at the heart of its operation is the company's use of trust funds, which rank among the top in the country. Last year, WHA sold over 4.5 billion baht worth of assets to its trust funds, which gives it great financial flexibility and additional income for investment. These two factors create a continuous engine for growth. And lastly, a question that a lot of investors may have is, what about recurring revenue? In the year 2020, our team forecast that the company's recurring revenue will stay in line as in previous years at a ratio of about 58 to 42%. This means that even if WHA does not achieve its land sales targets, it still has its existing long-term contracts to fall back on.
So not only do we see the upsides in the company's core fundamentals, but also the growth potentials that the business can unleash. The most impactful growth stimulator is the company's strategic clustering in the EEC, with electronics in Siliguri, petrochemical in Magdaput, automotive and the potential customized clustering in Rayong. Despite the delay, the EEC is coming via the recently approved projects, the high-speed railway and the Magdaput Industrial Port Phase 3. Such government-backed infrastructure are to promote Thailand as the industrial hub in the ASEAN region. WHA reaps tremendous benefits and advantages as 95% of its location are within close proximity to this infrastructure. Not only that, but the company's variety of locations and flexibilities gives it the upper hand compared with competitors. We also believe there's growth momentums in terms of foreign direct investment. With the growing numbers of Chinese firms relocation and the growing numbers of client base in the target industries, these numbers illustrate the upward trend despite the trade tensions. One of you may ask, what about trend reversal when it comes to the trade war? Because that has been partial rollback. However, geopolitical tension remains, which serves as stimulus for the continuous inflow of the Chinese foreign direct investment. WHA also continues to expand via the internationalization into the Vietnam market, penetrating both the industrial market with the Nga An project and also the water market with the Project Drone River. There's significant growth opportunities in terms of Vietnam industrial sector, as it is the primary growth driver of the country's GDP, up to 87%. At the same time, Project Drone River also complements the need for water consumption, not just for industrial, but municipal usage, exhibiting strategic diversification. Furthermore, another growth booster is that WHA ride on the alternative energy trend, supported by feed-in tariffs incentive in Thailand. With the current area at WHA's capacity, the company can capitalize on the growing demand for solar energy at 9.14% via an expansion into WHA and non-WHA customers' roof. At the same time, this is the strategic movement towards sustainable growth, which will also generate additional recurring income for WHA. All of the previously growth potentials fosters the company's growth potential as a whole, thanks to its integrated ecosystem. These growth potentials are catalysts for the rise in price and land sales for industrial estates, the rise in rental price with stable contract acquisition rate for logistics, the high demand and price growth for water, and the increased investment in the solar power generation and new plants. All of these are incorporated into our assumption for the evaluation.
So let's look into the valuation. Aside from the key growth driver, factors that are key to our valuation include new accounting regulation that negatively affect to income from power segment, a higher water demand from new power plants, and the high government put pressure on lower water price. For the WHA, we use some of the part method. Owing to the fact that each sector have different business model, we apply discount cash flow to value NOA from dividend income, rental property, water, and power, while EBITDA multiple was used to value for the industrial asset part. Terminal growth rate was assumed 2% based on long-term growth rate of Thailand GDP, and beta was derived from the relation between each sector and sales 50 for 5-year periods, of which result in the different value of WACC when evaluating each business unit. This is the enterprise value contributed to the company. Industrial asset is the highest contributor.
Using some of the part valuation, we come to a conclusion that the target price for the WHA is 4.3 baht per share, which means a 25.1% upside from the current price. And we can see that the current PE ratio is well below the 5-year average, and it's also lower than its peer, whereas the company fundamentals have not changed. This confirms that WHA is traded at a discount. And yet, as with any investment, there will always be risk, and we will highlight some of the important ones here. The first one is the uncertainty on large infrastructure projects, especially in the EEC area. The second risk is the economic volatility resulting from geopolitics and epidemics. And lastly, the possible regulation conflict with the Vietnamese government. In any case, the WHA has ability to mitigate all of this as the company is trying to diversify their portfolio, expanding to new market, and having a strong political connection. This would alleviate such a negative impact to have less consequences and lower the chance of saving case to happen.
Apart from the long-term investment risks, recent events that could have or have an impact on the WHA are the failure to secure Alibaba contract, the possible effect from exercising warrant, the coronavirus outbreak, and the possibility of being removed from Set 50 index. These events could have a negative impact on the WHA target price. However, we still expect some upside from the current market price. Then we increase our confidence in our recommendation by doing a simulation of Monte Carlo, which gives us 90% favorable result in investing in the WHA. With the three main catalysts, strong fundamental, growth potential, and attractive valuation, we believe that WHA embodies the future of Southeast Asia industry. Therefore, we reaffirm a buy recommendation at a price of 4.3 baht per share. Thank you. And if the judges have any question, we'd like to take them now.
First of all, good job with the presentations. I'll go first. So I guess this is one of the most popular questions. So it's quite obvious in Thailand that there's two choices as an investment proxy to play this theme, which is the WHA and Amata Group. So can you explain to me what is the why do you prefer WHA over Amata?
Okay, so we think that both Amata and WHA are good investment. Their valuation both show an upside if you buy it at the current price. But we believe that there are two key differences between Amata and WHA. The first is that WHA is, in terms of revenue, it's a lot bigger than Amata, so it has more financial muscle in that regards. And the second thing is the outlook of the company CEOs are quite different. If you look at Amata, we believe that Kun Wikrom is more focused on geographical expansion. So both companies are looking at expanding outside of Thailand because our neighboring countries' growth is more attractive. But in terms of WHA, we believe that Kun Jariporn also is looking at shifting to new manufacturing sectors as well. So both stocks are good buys, but if you want to focus on geographical expansion, we say Amata. But if you want to bet on the new shift in terms of manufacturing, then we say WHA.
Great presentation. The question I have is, you guys have looked at this for a long time. You know what's out there in the market. Can you give us some idea about what is new in the way that you look at it? You know, what is something that the market's not seeing that you're seeing in your analysis?
Okay, so in terms of WHA, as my colleagues have stated that WHA is looking in terms of the S-curves industries, the new shifts in terms of manufacturing industries. So that is the CEO vision, and we believe that we see that the company has growth potential in terms of targeting these S-curves industries, because just last year, about 63% of the investment within the EEC comes from the targeted industries. So I think this is like the main growth potentials that the companies can capitalize on.
You mentioned 1,000 RAI forecast. What makes you confident of this figure?
Because in the event that the Thai country faced the most the risk, the political risk in 2014, which is a hope they still acquire a land, sell land, acquire about 600 land. So this means that this current economic situation is not that bad, and we believe that the WHA has ability to acquire the same performance as previous years.
I think I have a bigger questions about how the company, let's say, balance the return to the investor, investor that, because it seems that for me, you have three main business. One is a power, which actually you have not touched on at all in your presentation. Second is a water, where you see the growth potential. And then the third one is industrial estate. It seems that half is industrial estate, which is very, I would say, volatile and high risk, while on the utility side is more sustainable. You have not, let's say, how you balance this kind of the risk and reward in your portfolio in terms of a Thailand opportunity and Vietnam opportunity. Can you achieve that?
Sorry, can we ask you to clarify the question a little more?
How can you balance your strategic growth in Thailand and Vietnam, given the fact that you have three main business: power, water, and industrial estate, and based on their risk reward characteristic?
You mean as if we were WHA or as an investor in the stock?
If you are, let's say, the seller to me, so you decide, you seek on the, let's say, management view, how you address this kind of the risk reward. But an investor, I'm not quite sure how you can sustain your land sale. I'm not quite sure how can you enter the new market
So actually, the water and power is actually closely tied to the industrial estate. So as you say, the industrial estate is quite volatile. Every year you have to secure new customers. So in terms of WHA, the way that they can increase their recurring revenue is to basically either sell new products or increase production of the water and power to existing customers. So in terms of new products, they have the demineralized water, which is, I don't think any other industrial estate has this yet. And also they have the solar rooftop in order to generate power for the existing customers. And one key thing is in Vietnam, they're also selling tap water. So they're expanding outside of industrial estates as well and selling to basically everyone.
Related to that questions. So on your valuation of 4.3 bars, right? Can you break it down between recurring and non-recurring?
For non-recurring, we calculate from the only land sale and asset monetization. We categorize this segment to non-recurring and other is recurring.
Yeah, my question is simpler than that. In this 4.3 bar, how much of this come from the non-recurring and how much of this come from the recurring? You understand my questions, right? Let's say 2.5 bar come from non-recurring, 2 bar come from recurring.
Just add the presentation is 58% from approximately 60% is come from the non-recurring and 40% is from recurring from our valuation.
Question on valuations, follow up. What happens to your valuations if the debenture market is closed, the REIT market is closed, and the property fund market is closed?
You mean target price, right?
Your valuations.
You mean the target price that will decline to if the fund?
The impact to your valuations and target price.
Yeah, it's mostly decline to just about approximately 2 to 3 per share.
And to continue on in that, just thinking about interest rates are really low right now, and it's possible that they could rise in the future substantially. Nobody's really expecting that, but there's a possibility, just like they fell much more than what people expected. And the valuation of this company is really driven by a very low discount rate. I'm just curious if you've done any simulations, like what would happen if interest rates went up by 1 or 2%? How would that impact the value of the company?
So our valuation was based on the previous interest rate before they brought it down. So in the case that if we base it on the current interest rate, if they don't issue any new debt, then we expect the valuation to be roughly about the same. But of course, there's news that they will issue about 7.5 billion worth of new debt.
What I'm talking about is, let's say, right now your forecasts are going out for many years in the future at a pretty low discount rate and a pretty low interest rate. My question is just, if in the next year or two interest rates start to really rise, have you thought about how that would impact the valuation?
Yes, if you fact our valuation, the company has more interest expense to, so it's lower the net income, and our target price will lower than 4.3.
And perhaps if I could add to that, of course, if interest were to rise, then bond yields would become more attractive, and people might be more interested in pulling investment from the stocks into bonds.
Okay, let's say what is your thought about the major let's say, the biggest risk in your valuation out of everything that they just asked?